Welcome back to my channel. Today I'm going to be speaking with Soma and we're going to talk about multifamily.
Multifamily. What is multifamily?
Basically, multifamily is an apartment building that has more than 5 units. 5 or more units, I should say.
Okay, which means that 4 units and below would be considered single family.
They're not considered single family, but they don't fall under the commercial kind of real estate.
Commercial multifamily.
Exactly, yeah.
Okay.
So the lending and stuff like that is very different.
Okay.
So 4 and less is you fall into the residential lending rules, and then 5 and more you fall into the commercial lending rules.
Gotcha.
And in this video, we're going to talk about the pros and cons of investing in apartment buildings in multifamily. I'm also going to share some experiences about some of the buildings that I've acquired, and some of them have sold. When is it a good time? Where to invest? All that good stuff.
All that stuff. So by the end of this video, you should be a pro on multifamily and apartment units, and you can make the decision for yourself if you think it's a good investment opportunity for you, and just to keep an eye open. All right, well, we'll start with, what are the pros of investing in multifamily? Why would someone want to do it?
So one of the biggest things for me is the way valuation works, the valuation of a property. So when you're looking at the residential, so 1 to 4 units, the way you evaluate you estimate the value of a property is by looking at comparable sales.
Yeah, comps, yeah.
Right?
Yeah.
Yeah, exactly. So often people call it comps. But these are comparable sales. So they're going to look at, if you're looking at a single family rental, you're going to say, oh, well, this single family rental is 1,000 square foot, 3-bedroom, 2-bath in this neighborhood, and 3 of them sold in the last 6 months, and the value of the property is around $100,000 or $200,000. And this is it. They're just looking at the comps.
Okay.
You can rent that house for $10,000 a month.
And be making killer cash flow.
Exactly,
yeah.
right? And then you have another one that's going to be losing $100 a month.
Yeah.
They're going to be valued the same way.
Because they're not using income producing as a way to
Exactly.
value the property. It's just the property itself.
Comparable sales. Yeah, exactly.
Interesting.
And then on the commercial side, the apartment building 5 units or more, the way that this is, they basically look at cap rate. And cap rate is kind of a measure of how well the buildings are doing,
right.
how profitable they are, without looking at debt. So if you were to buy the building on a cash basis, what would be the return on your cash?
And why do they look at it on a cash return basis, not with debt? Is it
because it's a
fluid,
variable,
right?
It's a variable factor. I mean,
Okay.
someone gets like 5%,
and
somebody
it's
is
not
10%.
your fault if someone's getting shitty debt.
Yeah, and it's to be able to compare.
Okay.
It's to be able to compare like this
Apples to
particular
apples.
Exactly.
Okay.
So this building on a cash basis versus this building on a cash basis. What is the cap rate? What is the return?
And then it's up to you to try to get the best deal on your debt to try to make the
exactly.
most amount of money.
Now, where the cap rate is kind of interesting is that the cap rate is used also in combination with the net operating income to estimate the value of the property. So they're looking at in this area, they're going to look at and say, this particular type of building, this class of building, they are at let's say 5% cap rate, right?
Okay.
And so that means that you're not making that much money. If you were to buy the building cash, you would be making 5% on your money.
Okay.
Based on that, right? So not that great a return, but just for it, because it's easier to calculate later.
Okay.
So that's 5% cap rate. So they're going to look at the neighborhood, this kind of building, blah blah blah. This 5% cap rate. Now they're going to look at, if you're looking at a building that is for sale. Sometimes that's the other thing that's interesting about commercial is they're going to say, there's no price. There's no list price on some commercial property. Sometimes they will put a list price, but sometimes they're just going to say, just make your best offer.
Here are the financials.
Exactly.
Tell me what it's worth to you.
Exactly.
That's crazy.
Yeah. Because sometimes, when you look at a building, you can look at the zoning overall. You have much more flexibility, and then you could look at it from, what is the highest and best use that I can do with this property, with this plot of land, with this building, and it could vary differently, right? So, and we can talk about the building that we were looking at, for example, in San Francisco. And then, we were transforming the building completely.
I see.
But back to my cap rate and net operating income. So then you're looking at the building, let's say it makes like $100,000 in net operating income.
Okay.
So that is basically, you get the rent, you pay your property management, you pay your insurance, you pay your property taxes, you pay your fees for maintenance and stuff like that. And then you're left with $100,000 a year in net operating income.
Yeah.
So notice that I'm not talking about debt here.
No.
I'm just talking about that. And then the cap rate, then you can kind of like work backwards and say, if the cap rate in this area is 5%,
then
that
based
means
on the annual.
Yeah, exactly. Based on that annual, I can kind of like flip the formula back and say, well, that means that this building would be 20 times $100,000, so that'd be $2 million.
Right, so you would do $100,000 times, divided by 0.05.
That's right.
And then you would get
$20
million. Okay, I mean, that seems super simple. And is the reason...
$2 million, right? The value of the
$2 million. I don't have a calculator, clearly. $20 million. So is the reason why it's calculated that way is because apartment buildings, when you get a commercial loan, are strictly looked at as an investment opportunity, whereas single family houses are sometimes, or more than often, primary residences, and so it's not normal to calculate things that way?
It's just the way that, part of it is how the building are appraised, like what the value of these buildings are. So that this is just like how people are looking at it. They're looking at it much more in terms of economic value. You also have more things that you can do with the building. So you could do, you could have laundromat, you can do offer other services, and you can increase the revenue. You can also, like when we talked about highest and best use, sometimes you're going to say, well, these buildings at the bottom, I'm going to do commercial.
Yeah, you're going to lease it out. Yeah,
exactly.
Okay.
So then I can increase the value of the property as long as it's zoned properly.
Zoned correctly. Amazing. Okay, so that's definitely the biggest pro. Is there any other pros for multifamily?
Well, I mean, this is to me the most
it's just
important,
such a big pro.
Because imagine now it's completely different now. If you have if we go back to our single family rental, now my house is making I'm renting it for $10,000. I could sell this house, instead of selling it for $200,000, I could sell it for $1 million, let's say.
Yeah.
Right?
Yeah.
I mean, this is massively different than what is currently happening. So you're kind of leaving a lot of money on the table. A lot of the single family rentals that we have, I mean, technically, if you were operating it as a commercial unit, you would be able to sell it much higher.
So this is definitely a pro in terms of being on the selling side. So if you're going to buy a property, whether that's residential or commercial, and you're going to increase its, you're going to optimize it for income, well, then you'd rather do it in a commercial building where it matters. Yeah. But if you're on the buying side, would that be a pro with single family? Like, you see a potential in a building to make a lot of money for you, and because you only use comps to determine the value, you could get some deals?
On the single family rental?
Yeah, on the single family side?
In single family rental, you're definitely getting a deal.
You're going to be able to, because even if it made, whatever, 1,000% in cash flow, or like if that was the return, it's not going to change the price for you.
Because if you look at it too, like the cap rate that we're doing right now, again, comparing as if cap rate mattered in single family rental, but the cap rate on single family rental, if you were to buy the house cash, we're looking at 8-10%. You are not going to find these kinds of returns in apartment buildings, or apartment buildings that you want to own in the neighborhoods you want to own.
Yeah, that makes sense. Okay, well now, what are some cons of buying multifamily?
Well, cons is the biggest thing is that they're hard to find. So it takes a while to find them, and then then you may not. Is it the right size? So how much money do I have to invest? If I have X number of dollars, then I can't go and buy like 100-unit apartment building. I can only buy between 5 and 15 or 20 unit apartment building, which is a very nice spot to be in, but
it's limited too.
You're limited. So now I can only search for up to 20 units.
Right.
And then where am I going to find them? And which the property manager that I'm going to use.
So
all
your
these
capital
things.
could be a restraint, which is a
Yeah.
con because it takes a lot of money, and then the inventory
Yeah.
could also be the con too.
Inventory, yeah.
And would you say that, I know we've talked about this a little bit, but multifamily is kind of popular right now. Do you think that that's kind of a con, that people are really, their ears perk up when they hear about that?
Yeah, and I'm not sure why, but yeah, a lot of interest in
Yeah.
apartment building. It is the wrong time to do this. Right now, there are no deals. I haven't seen any deals on apartment buildings.
yeah.
Everything that I'm look at is completely. It's either completely redone already, and then you can't add any value. And then if you buy it like that with no value add, then you don't cash flow, or you
Right.
very very little cash flow. So you end up in a 5% cap rate. So the nice
So,
thing about the 5%
okay.
cap rate too is that you look at it and say, well, this is 5% of the, based on the value of the property. This is my return on the value of the property. But if I get a loan on top of that at 7%, that means I'm paying the bank 7% of 75% of the value of the property. So that's higher than my 5%, my return on the whole building.
And you're losing money.
So, yes.
Yeah. So is that because it's turnkey that the cap rates are low?
Well, that's what I'm seeing right now in
Yeah.
the market. A lot of it is just turnkey.
So
and
that's
then
an
it doesn't
interesting point, that like in order to make multifamily work, it also has to be a value add situation.
Well, ideally.
Ideally,
yes, that's
ideally
right.
a value add situation.
Sometimes it could be, and you can add value differently. You can say, well, the rents are minimum. Like why? Because especially if you look at apartment buildings that are less than 30 units, often you're going to find that they're owner operator. They're managed by the owner of the building.
That's also limiting. Yeah.
It is very limiting, and also it's very interesting because we're going to talk about 1460 Monroe, and when we talked to the owner of that building, he was like, "Oh, you're never going to increase rents on this thing. This is like people don't, there's no point in spending money. That's why he's getting rid of the building." I was like, "What, really?" But we more than doubled the rent.
So
when we
maybe
owned the
he was
building.
just so in the weeds that he kind of like
Exactly.
boxed himself in.
Exactly. So sometimes you have your perception.
Because if you're too in the day to day and you know each tenant by name,
Yes.
and you're like, you have this connection, you're like, oh, well,
Yeah.
you can't see bigger than it.
Exactly.
Interesting.
You kind of have, so that's why I like to be a little bit remote
Out of the business,
out of that, like the management detail, because
Yeah.
it gets, it could be a little bit, I don't know how to say it, but yeah, you're too much in the weed and you see too many problems.
Well,
and
yeah,
not
I mean,
enough
if you're in it,
opportunities.
it's hard to see the bird's eye view
Yes.
and how to grow it
Yes.
and do better.
Yeah.
That makes sense. That makes sense. And so I would love to know, we talked about the pros and the cons.
Mm-hmm.
When was the last good time to invest in multifamily that you think, if now is not a good time?
I would say probably like five years ago.
Oh, so pretty
maybe
recently.
It's pretty recently, yeah.
Okay.
Yeah.
And do you notice like a pendulum swing at all in terms of like good time, bad time, or like how long that cycle is?
So I'm not sure how that cycle is going to play out. What I'm seeing right now is millennials are in what's called family formation. So a bunch of them already have gone in that direction.
Yeah, if they
But
haven't had families already,
but
they're about to.
Exactly, right? So these are people that, they're single, but they have a partner that they want to kind of live their life with. And now they don't want to live in the parents' basement. They don't want to live separately, so they're looking for somewhere to move together. And now they're
Right.
thinking, okay, well, we're going to have a family, so
Need space.
I don't want to be living in an apartment in
Right.
downtown LA to raise my kid. Nobody should be living downtown LA.
Period.
But period. No humans. But yeah, so that's kind of like what needs to
Okay,
happen.
so you're seeing like this exodus of a generation that
Yes.
what is living in apartments now kind of leaving. We're in between the phase where Gen Z is living in apartments. They're still graduating college. They're still younger.
Yeah.
So you're maybe in like another 5 years, it could be a good opportunity again.
It could be, but millennials is the largest generation right now. We talked about the boomers when the boomers was what used to be the largest generation cohort
Yeah.
that existed, and it had a massive impact
On the economy,
on
yeah.
the economy,
Yeah.
and it affected everything. And if you can follow the patterns are very similar that you're going to see with millennials. Millennials now
They're a really big
largest,
cohort
They're the
as well.
largest. They're larger than boomers.
Wow,
Yeah,
because
so-
they died off.
What?
What? Because boomers died off, or why?
I'm not saying that.
Okay, cut that out.
So that's what I'm saying right now. And normally you're right. I mean, there would be some kind of like pendulum swing and stuff
That's
like
what.
that.
Yeah, I was trying to see if you've identified or maybe like predict another pendulum swinging back the other way.
So right now, what I'm seeing is the family formation for millennials.
Okay.
They're gonna go to single family rentals. They
I
want to
see.
raise their kids
Yeah.
and have their dog in the picket fence.
I also notice like a lot of people, from what I see from my generation on TikTok, like I feel kind of caught between millennial and Gen Z. They call us zillennials.
Yeah.
But what I see a lot of from my generation is people talking also about like kind of being done with the city life and hustle culture. They're kind of over it. I say that as we're sitting in Times Square right now, but they're starting to romanticize the simple life and romanticize having a yard, having space to breathe, maybe not necessarily busting their ass to climb the corporate ladder,
Yeah.
but maybe just taking a regular job, not having much pressure to accelerate, but just living life a little bit bigger,
Yeah.
you know?
But then that happens when you're thinking about
Building a
building a
family,
family
yeah.
and your children,
Slowing
and then
down
you're
a little
saying,
bit,
well, how do
yeah.
I want to raise my kids? Do I want to raise my kid
In a
this?
400 square foot
Yeah.
unit, yeah,
Right?
for
And
the
then
same
where
price.
are the schools going to be? Like where?
Well, they're not going to be in
right?
these, yeah,
In downtown LA, where do
they're
you
not.
send your kids to school?
Yeah.
Like reform
You're gonna want
school? I don't know.
Jesus.
Prison?
Prisons are raising our children.
Right, but where are the schools?
Yeah,
Like,
they're going
you
to
have to
be in
be somewhere.
more suburb
Yeah, exactly.
areas. Okay, so that's really interesting to note that timing is really important with multifamily, almost like probably the biggest factor,
Yeah.
other than capital.
And then the next thing, in terms of cons too, like you have to, the due diligence is completely different. I mean, when you buy a single family
Right,
rental, it's fairly
right.
simple. You have an inspection, and then you understand all the mechanics and all that kind of stuff. It's pretty
But
simple.
there's so many more numbers to run with multifamily, and there's a lot more responsibility on the owner to do more maintenance, right? Like, for instance, lawn care, snow removal. Typically, that would be on the tenant, but
Yeah,
not in a
that's right.
building.
Yeah,
right?
garbage, and then you have all the hallways
Garbage,
and
pest
stuff like that.
control.
Yeah.
Even in my building, like I'd say they come and change the filters. They do pest control every couple months.
Yeah.
So there's a lot more responsibilities.
Yeah.
I see.
That due diligence could be a while. So it takes a while to find a deal. It takes a while to negotiate agree on the deal.
And
then
then
you
you
probably have
gotta-
like a couple of months of due
Months?
diligence. Yeah, you want to do due diligence on all kinds of different levels. You want to visit every single
Wow.
unit. You want to have
Holy
then you have the AC guy go in and look at all each AC and electric and all that kind of stuff.
So would this happen while you're under contract? Being under contract would just be like a 90-day close instead of
Yeah.
a 30-day close?
Yeah.
Wow, I didn't know that.
Enough time, then you have to also have constraint in terms of the financing. Make sure you can get the financing that you need.
How long does it take to close on a loan for a commercial loan?
Well, so you would kind of like get that started along at the same time in parallel,
Okay,
and then they would
yeah.
wait for due diligence and stuff like that. But yeah, you would. But it
Okay.
would probably take, after the due diligence is done, the inspections is done, and you have your final numbers. Then maybe a couple more months after that to get the loan closed.
Okay, I'd like to move into more about the loan.
Okay.
Can you tell us a little bit more about what it's like to get a commercial loan and the qualifications and the process of that?
For these commercial loans, they're looking, of course, at the purchase price that we are negotiating. They're going to look also at the inspection. So if there's any kind of major repairs.
Oh, they
they're
care
gonna
about that kind of stuff.
Yeah, they would care about that because
Wow.
sometimes if there's like delayed maintenance, they would want you to make sure that you have a plan to fix those delayed deferred maintenance. The commercial loan, they're doing the loan on that building.
Not you.
Exactly.
So it doesn't affect, does your credit score matter?
Your credit score matters, yes, because they want to know that you're a responsible
Okay,
person and
so
stuff like that.
that's there.
Then you have
But
also,
your income doesn't matter?
Your income doesn't matter.
Okay.
No.
The
But-
income of the building matters.
The income of the building matters, yeah.
Okay.
So because of that, so they're basically lending on, there's a piece of real estate, but also on the economic value of that piece of real estate. So
That's why
how
they
much-
care about that maintenance, because it's going to
Exactly.
come out of someone's pocket.
Exactly. Exactly.
And they're
then if you don't do it, and then half the building is
empty.
Empty.
It's not
then,
cash flowing. You're not going to pay your loan.
Exactly.
I
So
see.
the other big one that they're looking at is the 12-month rent roll. So how well have they paid? The tenants have paid. What's the average rent and all that.
How does it work if you're planning on vacating all the units and doing a huge unit turn and doing a bunch of renovations? So would they still care about that 12-month rent roll?
Well, normally you would share that kind of information with them, and then you would do the rent. You would basically, they would care about it, but then you would have to explain that. So we're gonna flip like 6 units or half
And what
the
kind of
units.
like proposal would you have to give them to show them what the rent could be?
Well, it's so that really depends. Like normally they don't really care about what the rent could be.
Oh.
Because they just it's just kind of a fluff number. So
Right.
it's just like you can make whatever number you want. We care much more about kind of like the actual thing, like what's actually how much money you're going to spend on the property, and all that kind of stuff.
I see. Okay, so it's based on the numbers today, so they will care about the rent roll still.
Yeah.
Because they want to know worst case scenario, the building still works.
That's right.
Okay.
And the fact that, hey, you know what, we've done an inspection, we're planning to spend an extra $500,000 in the building.
Right.
So they know you're increasing the value of the building.
Okay.
And so you can share that in all your proposals.
And is that an advantage for them? Do they like to see that?
This is absolutely an
Yeah?
advantage.
Okay.
You're buying a car that's kind of all, I don't know,
Dinged up.
doesn't work and
Yeah,
all that kind of
you're
stuff. And some
fixing
guy says, I'm going to fix it, I'm going to paint it, it's going to be brand new. Do you want to invest like $1,000 in it? I said, yeah,
Oh,
okay.
sure,
So-
why not? You're going to fix it
You're
anyway.
gonna do all the work. Okay, sure. Yeah, so,
I see. And how difficult is it to get a commercial loan if you're a first-time investor, if you don't really have a track record?
Yeah, so the track record is pretty important.
Because
So-
that could be another con to
Yeah.
investing in multifamily if you don't have a track record. Like, how do you prove yourself?
Exactly. So you could have like a professional property. You will have a professional property manager that's going to help.
So someone
But
who has
still-
experience on your team, but not
Yes,
you necessarily.
Exactly, but that helps you only a certain way.
Certain amount.
Certain amount. Then the rest is going to be about kind of like how good are you with managing these kinds of renovations, these kinds of buildings, and all that.
What kind of
So
experience
track
would they
record?
be looking for? What would be ideal to see?
Well, so when you get started, I mean, you have to start somewhere. So
Right,
for
exactly.
us-
So where
us-
would you start?
We start like with single-family rentals. So we showed that, hey, we're doing this many single-family rentals, and
I've managed this many renovations. I currently have X amount of tenants
Exactly.
right now. So your track record doesn't have to be with multifamily. You just need a track record.
Yeah, that's right. They know that you
That's doable.
They know that you can manage. It's a significant amount of money, right? I mean, it's $1 million, let's say, for a small apartment building, and then you're going to put like $300,000 or $400,000 in renovations. How do you communicate? How do you manage all of that?
Yeah,
So
because
it's
you're
a
putting
significant.
a lot of eggs in one basket,
Yes,
really.
that's right.
Would you consider that another con? The fact that
Yeah.
a lot of your money might be going towards this one building, and if something happens to this one building, you could be wiped out in a sense.
For me,
Or is that a benefit?
I'm not so worried about the wiped out part of it, but I'm never am. But the one thing that is important is that it is a big building, so you have 16 units, so it's a little bit less flexible. We talk often about how real estate is not too liquid.
Right.
So if you want the money, it's kind of hard to sell.
Is it even less liquid with multifamily?
Well, yeah, it's a lot. We have one building right now that we have on the market. It's been on the market for over a year.
What? I didn't know that.
Yeah. So
Oh, wow.
kind of like soft.
Soft on the market.
Soft
Like if
on
you
the
want
market.
it, you can
You
have
can
it.
have
But
it.
you were not
But
pressed for time to sell it.
4 years ago, I mean, people were calling us. That's why we sold our buildings.
I
We sold,
remember
like, 4
you sold
buildings.
one 2 years ago.
Yeah. So people were calling. They said,
And
"Hey,
I
we want to buy your
remember
building."
you guys were pretty
Crazy
shocked
number.
at what you got for
I
it.
know, yeah. That's
So
why we
why
sold
don't
it.
we, good transition actually, why don't we talk about your personal experiences with apartment buildings? I know your first
Yes.
property ever was an apartment building, which is crazy. That's quite an anomaly, or a unicorn as you would call it, right?
Yeah.
That was a pretty special
Yeah,
circumstance.
Absolutely.
When was the next time after that you looked at multifamily?
Well, looked at multifamily or actually bought a multifamily. So I looked at multifamilies along the way for years and years.
Okay, that's always been on your radar.
Yeah, it's always been on my radar. I was looking in San Francisco Bay Area where I lived, I talked to investors there. I had tons of money at the time, and I was really looking at investing.
So why didn't you?
And the numbers didn't make sense.
In San Francisco.
In San Francisco.
Right.
So the numbers basically didn't cash flow. So if you were to finance the deal normally, like 75 or 80% of the purchase price, you wouldn't be able to, the house wouldn't cash flow. They would lose like significant amount of money.
Yeah.
If I was to put more cash in, just so that they cash flow, then this like
it's using so much of your money. Yeah.
Then your cash on cash return is like 0 or 1%.
Because then you're not able to use leverage properly, so it's kind of sad.
Exactly.
Okay, so California didn't work for you. Then what was the next time you seriously considered multifamily again?
So then we looked at commercial. So in San Francisco, we looked at actually buying a commercial building and then turning it into what's that called, like multi-purpose or whatever. When it's like
I don't know what's called.
Commercial at the bottom. Anyway, so we looked at doing
commercial at the bottom, rentals at the top.
The rentals at the top.
That's really cool.
So there's a word for that, but I forget. So we actually had like a letter of intent, and we were just looking at buying this building. I put an offer. This is a perfect example of it. Was a grocery store in downtown San Francisco, and we were planning to basically tear it down for the most part and build I think it was like 8 units on top of that.
Wow.
And then underground parking garage.
Holy, that's a big job.
Yes, that was a big job. And that was listed with no list price, so just make an offer.
Oh, so your calculations told you what then?
So then we looked at kind of like what do we need to buy it at, and then also what is the highest and best use for that property.
Right.
So that's when we decided, okay, well, we need to have like 8 units apartment, residential on top. We have the parking garage. We can have commercial in the like street level. What can we rent that per square footage and all that kind of stuff. So what is that value of the property? And to kind of look backwards at, okay, what's the cap rate in San Francisco for these kinds of things? And we end up that the after repair value, the value of the property after we were done, would be around like $45 million.
Holy
something like
shit!
That. Yeah. And then you kind of go back out of that, and then you say, well, we can make an offer, considering all the development, all the work that needs to, all that, and then we put an offer for $14 million for that building.
Wow.
So yeah.
And clearly, that's not part of your portfolio. So what happened?
So so we worked through it. We tried to. We had someone that would lend us the money.
You had the lending already lined up.
That's right. But it was very difficult to work with San Francisco because there's a lot of permitting, lots of regulations.
Oh, okay, because you had a big job to do.
And then on top of that, the facade might have been historical facade.
Oh, so then you'd have to keep that, and
that's
only going to add to
that's right.
the work, because now you can't just tear down, start from scratch. You have to work with what you have.
Exactly.
So how long were you under contract before you realized it wasn't going to work?
So I think we were under contract for about, I think it was like 6 or 9 months, and then we're paying interest in that time.
Motherfucker! Almost a year?
Yeah. But we didn't put the $14 million up front.
Well, no,
right?
I didn't think that.
We just put like $200,000 down payment or something. Like
How much?
$200,000, something like that.
Just $200,000.
And then
I thought you said $2,000.
And then some of that money was actually borrowed from somebody else, so we were paying that person like interest.
Oh my God! When was this?
That was 2016, 17.
That was relatively recently.
Yeah, pretty recently.
So, were you ever accounting for appreciation? Like, I get it. California has a lot of red tape. San Francisco has a lot of red tape. It's difficult. It's a historic building. But did that add to the value at all, or add to what it could be valued at?
Yeah, it could be. I mean, it could have made sense to do it, but the lender basically wanted us to wanted more stuff. Like, so for example, at the beginning when we talked to the lender, they say, okay, yeah, we'll lend you this. Let's just like no problem. And then they say, okay, well, what we need you to do, we need you to go and talk to an architect and make sure that your plan works.
So they kept increasing the laundry list of items to get you qualified.
Before we lend you the money, you need to do have an architect.
Common?
Well, I don't know. I guess so. They can ask whatever they want.
Because it's not like a straight bank loan, right? It's,
no.
They can make whatever requirements they want?
Yes, yeah.
That's kind of scary to not know what you need to have before you close.
Yeah, exactly. But I mean, it's part of the
business.
Part of the business. I mean, you work with them. I mean, maybe if we had a bit stronger relationship, if it was our like 5th deal or 10th deal with those guys,
they wouldn't have been so picky.
They would have said, "Oh yeah, let's do it." You know.
Okay.
But so this one they wanted. So then it was the architect. Well,
right.
The architect, that's another like 10, 20 grand, whatever, for the architect to do the work and all that. And then after that, they said, well, before we can lend you the money, we want you to go through permitting.
Oh, they wanted you to get permits already?
So that means that, okay, well, I have to come up with $14 million up front to buy the building and then to go through the permitting and all that kind of stuff and all the things. And that could take 2 to 3 years, according to the architect, the guy that works with the city very closely.
Oh my God, and you still wouldn't. Oh my God.
And then we're kind of thinking, okay, well, how are we going to we need to make money during that time.
During the time, yeah.
So we talked about using the current commercial space as a garage and then parking garage.
But that probably wouldn't be enough, right?
No, that's right.
Yeah.
So, but it's just like save a little bit of money. But
no wonder some garages are like $50 parking.
Yeah, that's
They're trying to get through their permitting.
Because we want to build something great on there. But so that was a great learning experience for sure.
Okay, so then where did that take you to when you actually bought your next multifamily?
So this was and then after that, then we said, oh, screw this.
Screw California. We're going to the Midwest.
I was trying to give California a chance, but
and
they just wouldn't take it.
She's stubborn.
No, that's right. So goodbye. So broke up with California.
And then who'd you find next?
And then I found Memphis.
Memphis, Tennessee. Miss Memphis.
Yeah. But we did a lot of single-family rentals.
You did, yeah. I mean, we're skipping a bunch of the story, but there was a lot of experience that you had growing Martel Turnkey, doing bunch of deals, which then led you to know and trust Memphis and have a team there.
Yeah.
And then when did you end up buying your next multifamily then?
So that must have been, I can look at my note.
Yeah. Would love to know that as well as like a little bit about the numbers if you have a ballpark.
2019.
Wow.
Yeah.
Just 5 years ago, literally when you said the last time that was good to buy. Yeah. 5 years ago when you bought.
So this was great. So that's this building we purchased it for. It was a 20-unit apartment building, and the average rent was $560 a month. The purchase price was $985.
$560 a month for like a studio, 1-bedroom?
It was a 1-bedroom, yeah.
Wow.
Yeah. And then when we talked to this guy, so this was owner-operator.
Was this the owner that was a little closed-minded?
Well, I don't know. It was a little closed-minded about the value of this building, which is fine.
For you, the buyer.
It worked for us.
Worked in your favor.
But how this building came about is because we had a solid track record. We had done a lot of single-family rentals. People recognized us as having done all these single-family rentals, and then...
So you built your track record, and that was important for you.
A realtor contacted us and said, hey, are you interested in apartment buildings?
So the opportunity came to you?
Yes, absolutely. It was not even on the market.
Wow, that's interesting to note because I guess that proves how important track record is as an investor if you want to get into multifamily.
Yeah.
Not only is that good on like a relationship level, but I think as an investor it's good so you're prepared for the ups and downs of owning a building.
Yeah.
Great. Okay, so then this opportunity presented itself to you.
Exactly. So this was great building. I mean, it looked fine. It obviously needed a lot of repairs.
Okay. I'm guessing the numbers looked a lot different than the California building.
Oh yeah, definitely. But the purchase price for one was like $985, so not
under $1 million.
Under $1 million
for 20 units.
For 20 units, yeah.
Crazy.
And they had a laundry room and all that.
Wow. And what was the name of this building?
That was 1460 Monroe.
This was Monroe.
Yeah.
And what was the area like? What was like the surrounding neighborhoods like?
Yeah, I mean, it was a very nice area. It's Monroe Street is it's kind of like in Midtown area.
I think we drove past it.
Yeah, probably, yeah.
I remember seeing there was a lot of cranes around that area, and it was it was up and coming.
Yeah,
for sure.
And there was also a lot of there's like eye care thing. There's an ophthalmology education, kind of like university
So
school.
it was like a mini community. It had
Yeah,
everything.
and also if you're a lot of the people that are in Midtown too, like they work at the hospital, they work at St. Jude, they work at all these places. So these are great people to have as
Yeah,
tenant.
great.
They work well and they well
Have stable,
paid
secure
and
jobs.
exactly.
Everything. Yeah.
So
Amazing.
it was pretty good area, and they were building a Starbucks.
That's how you know.
So this is up and coming.
Starbucks and Whole Foods. If you got any of those.
And gays.
And who?
Gays.
Oh. I thought that was the name of a
Follow the
restaurant.
gays.
It's true. The gays have an eye for beauty.
Yeah.
The potential. The
They're
gays
gonna
have an
make
eye
it-
for potential.
They're gonna make it nice.
They're gonna make it nice.
Absolutely.
It's true. No, because every town that turns around from being a little bit sketchy into a good neighborhood
Yeah.
always has a gay bar first.
Yeah.
It's
So,
true.
There you go.
And then it ends up being the most expensive neighborhood.
Yeah.
I've seen it happen in Toronto. I've seen it happen in Vancouver, and it's incredible the way artists and gays. I'd say anytime artists move in, because they have an eye for like seeing beauty in something that isn't necessarily like a diamond in the rough almost.
yeah.
Like they can identify the diamonds in the rough.
Yeah.
I have another question about this building specifically.
Yeah.
How long did you hold it for? What renovations did you do? And then what did you sell it for?
So I think we sold it for over $2 million, and then.
How long did you hold it
I think
for?
we held it for 2 years. Something like that.
It doubled in value in 2 years.
This is the nice thing about.
Were you about to say problem?
No, this is the nice thing. This is the problem about this. That you
God,
make
it's such
too
a
much
problem.
money, and then you have to figure out what to do. But yeah, so it was. We sold it like for $2.2 million, and then.
Wow.
So yeah, I mean, this is the power of the commercial real estate. When you do this value add, and then you can go and you have a good cap rate,
Okay.
and then yeah.
I can see why people are so intrigued by it, because it's powerful.
Mm-hmm.
It's quick. It's powerful. Aside from all the cons, I guess that's what makes it so attractive,
Yeah.
is stories like this.
Well, yeah, but we wouldn't be able to do this today. Like it would be very different.
Right.
It would be a very different story today, because we wouldn't be able
Right.
to buy this deal, because a lot of the people are seeing, apartment buildings. They're priced a lot higher if you can find something that's value add like this. And
What value did you add? What did you do to the
so
building?
we did what in terms of the. Let me look at that. Like, what do we spend on? I don't know. I think we spent like
Ballpark.
$300,000 on that on renovations, maybe a little bit more, but.
That is an insane increase in price.
Yeah, so
That's
bought it for
insane.
$985.
Do you know what the units were renting for after you renovated?
Yes, $850. So it started at $550 or something like that,
to
and then
$850.
it went $850.
That's a
So
significant
almost double.
increase.
Absolutely.
Wow.
So I think we spent like $10,000 per unit.
Okay.
And then after that, there was the pavement around, the parking spots.
Exterior stuff, okay.
And then also the landing. So the landing had to be redone
Wow.
all around, and some ACs had to be changed. And all that.
And
So-
now you still have an apartment building.
Yes.
And what's the situation with that? What's the story with that?
So this one,
Is this one in Memphis too?
this one is in Memphis as well. This
Okay.
is in
You're looking at me like I know. I don't know.
where is it called? Anyway, so it's a very nice area. It's in Midtown as well.
Oh, it's in Midtown too.
Yeah.
Okay.
Overton Square. So great building. When we came into that building, so
Did you buy it the same year?
we bought it a little bit later. What happened is that, again, like so, we did 1460. Then we did another building a little bit also on Monroe, and then we bought the parking lot beside it, and we did a bunch of stuff. And eventually, this building came about
In 2020?
also in 2020, yeah.
Did COVID change things at all for you financially with
No.
the purchase or anything like that?
No, not really. So I think it
Okay.
was before COVID. So
Oh, it was early 2020.
Yeah.
Okay. Jesus. With this building, since it was a year later, I'm guessing the renovations happened a little bit later, and then you decided to sell it a little bit later, and then it was too late? Is that kind of the story?
So The plan going in there was the building was $1.8 million
To purchase.
to purchase.
Oh, significantly more.
The average, so it was a 16-unit apartment building, and then
And less units.
the rent was $915.
Oh, okay, high rent.
So it's definitely a nicer area. Overturn Square is like, it's a very nice area.
Okay.
It's in Midtown, but there's also like it's a little bit commercial. There's the ballet is there. There's like a theater. There's
Okay.
bars and restaurants. It's very, very nice area.
Yeah.
And the crowd that's out, there's also like a concert, outdoor concert area.
Oh, wow.
So it's very nice.
Okay.
And so that's why the rents are a little bit higher.
Yep.
The price of the property is also a little bit higher.
Double.
And then the plan was to increase the rent to, we thought that we could increase the rent to about $1,400.
So you thought you
so
could
from $950 to $1,400.
increase it by like
That's correct.
$500. Okay.
That's what we looked around, like in terms of comps for the rent.
Okay.
Around that area. So that's what we thought. There was a couple of new buildings that were being built, so we looked at those, all that. So when we look at these buildings and said, well, we're going to renovate it in order to bring it to $1,400, we're going to spend $10 to $15, let's say $1,000
Per unit.
Per unit.
Okay.
Right, and then we need to put in-unit laundry.
Oh wow.
Yeah, and then we have to do certain things, blah blah, and then we look at the whole cost of the renovations for doing that. So you make it very nice. Obviously, the whole thing the windows need to be changed. Maybe the kitchen counter needs to be. So you need to bring it to that level.
Yeah, different standard.
So that you compare, right?
Yep.
So, but we don't do it like for all the units all at once. So we kind of
unit
like
at a time?
we do a couple of units and we try
Okay.
and see if we can get that rent first.
You're
So
testing
we
the
spent-
waters a
So
little
we had
bit.
a couple of units that we did. We renovated like full on with everything that we wanted to do to what we thought we would be able to bring $1,400.
Okay. And did it work?
And no, it didn't work. So
I see. And so is this why it kind of affected your ability to sell the property then?
yeah, exactly. So
I
so
see.
now working
projections were a
the other
little bit
way
off.
around, and
Okay.
you're looking at it and say, well, this is the net operating income now.
Right.
And then, this is what.
So
we
is
could
this
sell the
kind of
property
like a situation where you just want to hold on to it until it appreciates and the community does other improvements to bring up the value for you?
So the other problem that we have with this property is that we have investors. So,
So there's a little bit of pressure.
so yeah, a little bit of pressure. So
I
the
see.
investors want their money out, and then we can.
The other building was just you and your son Antoine.
Yes, that's right.
Just you two.
That's
So
right.
it was up to you when you want to sell, you want to keep, whatever you want to do.
That's right.
I see. But this one, there's a lot of
This
other
one, investors,
Okay.
and then we still own like 60-70% of the building, but
But
the
still.
investors want money, so
I
we kind
see.
of entertain that, and
Okay.
yeah.
So now I think the last thing we haven't really covered is location. Why you chose, I guess, Memphis, Tennessee over California. We kind of covered that, but in general, is there specific states, areas, neighborhoods that you should be looking at if you want to invest in multifamily? What kind of price ranges? Like, what's some of that criteria?
Yeah. So, I mean, I look at the same kind of demographic that I'm looking at before, like the business diversification, kind of like a slow growth in terms of demographic, in terms of
Slow
population.
growth, younger demographic,
Yeah.
professionals.
Well, not necessarily, but yeah, but they actually low unemployment.
Low
rate, so that
unemployment,
people
okay.
are, and then I look at the median household income.
Oh, okay,
And
median
I'm looking
household
at
income.
I look at the median house prices, median rent.
What
as
is
well.
the sweet spot for purchase prices with multifamily? Like, I know you have a sweet spot for single family, and you always say it's under 200,000, but over 75,000, 50,000?
Yeah, so I think
Between
per
that
unit,
range?
per unit, you mean? Yeah. So
What
so
would-
you would look at around like $60,000 to $75,000 per unit.
Per
That's a good-
unit in
Yeah.
in a multifamily.
Yeah.
I get it. Okay, and I know you can't look on Zillow. What services or tools do you use to look for apartment buildings?
So LoopNet is one that is being used quite a bit. A lot of people say that you can't find any deals on LoopNet. but
Yeah.
A lot of people also say you can't find
can.
deals on MLS.
So?
And we found tons of deals on MLS.
Guess it
So-
depends on your endurance.
But ideally, you would want to go and call people.
I see.
figure out what
Make
these
connections,
make connections, and then
network.
call the owner and stuff like that. It's a little bit more
Seems like
complicated because
the off-market
all of them
stuff,
are
yeah.
owned by LLCs. So you have to find out who owns the LLC, and then kind of like do your.
I know that
research
something
on
you
it.
can do is like use LoopNet to make connections with realtors who do
Yeah.
multifamily, and then ask them if they have anything else on their radar,
Yeah.
or to keep you in the loop.
Yeah.
Email you, keep you in contact. That's another kind of option.
That's right.
But then also building your track record with single family and making long-term connections that way too, so people trust you as an
Yeah.
investor.
Yeah.
Okay.
Absolutely.
In your closing remarks, what would you say is advice for people who are thinking of multifamily or have their eyes on it?
Forget about it. Forget about it.
Is that actually your advice? Not yet. Okay, maybe forget about it for now.
Oh, forget about it for now. So, in my opinion, it's not the right time for buying multifamily. I think there is going to be a time where it's going to make sense,
Just not today.
but just not today. You have to be a little bit more opportunistic. I mean, things are gonna.
Yeah.
For us, the deals came to us.
Yeah.
And maybe if you have a situation like this where a deal comes to you, then you have to, and it makes sense.
I
you
think
know,
what
you
a
can
lot of people
execute.
forget is like they just think multifamily is a good way to make the big bucks, but what they forget is like if it's just about making money, there's lots of ways to make money.
Yeah.
You can make a lot of money in single family. You can make a lot of money doing smaller projects but just at volume
Exactly.
instead. And so I think some people might just have their sights set on something because it sounds pretty or sparkly, not realizing that there's so many other ways
Oh, yeah.
to get there.
Yeah, it takes a while. I mean,
Right?
it takes a while to renovate the whole building.
Exactly.
It's just like
there's pros and cons like anything else.
That's right.
And so it's not a perfect solution.
Yeah.
There's a lot of ways to go about it.
Yeah.
So in the meantime, build your track record.
Yeah. And single family rental is great because you can do, you don't make as much money,
Yeah, but there's
you
so much more
you
volume.
can make it a lot more frequently.
Frequently,
you can have a whole
yeah.
deal flow going, and you're gonna make.
And you
more
can
money
diversify because if let's say one house, something happens with it, like I mean, I know you don't like to think about it that way, but I'm very much like a worst case scenario person. Like if there's a huge infestation in one house,
Yeah.
it's not going to trickle into my other units because
Yeah.
they're separate.
Yeah.
They're different. Or if let's say in one neighborhood I have a house that has really strict code with the city, that doesn't mean the other house does.
Yeah.
And so I might have to do heavier renovations here and spend more money here, but then maybe this house will help balance it out.
Yeah.
So
Yeah. And if you want to divest, if you want to sell, you need some money for whatever reason.
you don't have to sell the whole thing.
I don't have to sell the whole building.
Yeah.
I can just sell a single family
One
rental
house.
or two.
Free up some money.
I don't have to sell
Take
16.
care of what you need to, yeah.
So.
I see. All right.
In my opinion, right now, it's not the ideal time to invest in apartment building and multifamily. But so I recommend investing in single family rental. Later on, I mean, this could be still play in very nicely as you're working with single family rentals. You're going to build your track record, you're going to build your capital, you're going to build your experience. Then once you have an apartment building, a multifamily as an opportunity, then you're going to be ready to execute on that deal. So that's my recommendation right now. And remember, I'm just here to help you make more money. And if you like that too, make sure to subscribe. And
See you next time.
Yeah.